Welcome to PWOM, Positive Word of Mouth, the podcast where we sit with extraordinary individuals with their extraordinary stories, where that we extract their lessons, the wisdom, the truth of creating something remarkable. And today we are going to dive deep into investments. How do we invest and how do we find an investor? To discuss this, here with me is Leo Fernando, who's joining with me. Thank you, Leo, for joining with me for this conversation.
Thank you, Hishan, for having me, and I look forward to sharing what I have learned over the years with your audience. And thank you again for having me.
Thank you very much because I'm itching to ask so many questions from you because investments is an area which is a bit of gray for any founder.
Yes.
And also personal finances, business finances,
Yeah.
and if you are thinking of being an investor, what to do,
Mhm.
right? So in this area, I want to start off by asking you, what are the types of investors or what are the types of investments that you have in the country or in the market?
Okay. Um, that's a quite a broad question, but let me just try to put it in the most simplistic way possible.
Yeah.
Looking at the types of investors, right? Actually, anybody with a pool of cash is an investor.
Mhm.
You, me, anyone is a pool of investor. Now, the question is, everyone does not have the time or the discipline to get a return out of that pool of cash, or sometimes they end up actually spending more than what they earn, right? But let me say that what most people are confident in investing is keeping the money in their bank,
Mm.
right? Everyone has a savings account in this country, right? We all contribute to the development of the country by saving, because then the banks use that money to generate a return indirectly out of your capital. So we are indirectly investing in that. So we are investors by saving. Then we might want a little bit more yield on a particular time horizon. So some we might go for a fixed deposit. That might be about sometimes 1 or 2% more than what we would get from a savings. So depending on the type of instrument, it might be a little bit more, right? Now, that is the more conservative sort of investor, right? And then as we go along, you have some people looking for a little bit more variable income, which they will actually look at investing in the market, get a return from the market, because hypothetically, saying that your fixed income gives you, say, 10%. Sometimes the market might give you 15%. So you might be like, you know what, for additional 5%, I don't mind investing in the market.
Yeah.
Then you have another category of investors who go beyond the market, which is more on the private side, which you will invest in companies, startups. A little bit more sophistication is required. So the type of investor, now trying to summarize all this, the type of investor, right, would depend on the availability of funds to invest, their risk appetite, and the sophistication. And based on that categorization, the types of instruments they prefer to invest, whether it's going to be fixed deposit savings or whether it's going to be um, market instruments like equity markets or any other market link instruments, or whether it's going to be private equity, land, or anything. It all depend on their risk appetite and sophistication and holding horizon. So I suppose I've answered your
Yes,
questions from
yes.
that sense.
So, how do I know when is the right time for me to bring in an investor to my business? Let's say I have started off a business and it's
Yeah.
ongoing one.
So yeah, so the it depends on the cycle itself, right? Because now, say for instance, if it's something which you've been in operation for a little bit, you have your cash flows a bit matured,
Yeah.
right? So which means you know what sort of investor would come in, and if your cash flows are matured, sometimes it might be, you know what, probably I can fund it from a bank loan,
Yes.
right? So you are stuck with a capital structure decision, whether you're
Right.
going for equity or whether you're going for debt,
Right.
right? Now, if it's an idea which you're funding,
Yeah.
right, you need to then go after a sophisticated investor, probably who would know a little bit more about exactly what you're pitching for, your business plan, what your idea, and has experience of going through a full investment cycle.
Hmm.
So that's probably what I would say your right time to bring the investor would depending on your cash need and how much you're willing to pay for it.
Okay, Leo, if I'm to ask you, if I'm starting off a business afresh, just starting off, at that time, now you said that when you're starting with an idea, you need to have a different type of an investor coming in. Then also you can decide on whether you can bring in a loan, whether you're getting into debt, right? And also this bootstrap journey
Yeah.
that you
Yeah.
have.
Yeah.
What is your view on that, and how would you recommend a business startup to go about with this?
Okay. Let me, for the benefit of your audience, I just thought, Mark, because finance in itself, it's quite complex.
Yes.
But there are too many moving parts, which a lot of people tend to struggle to grasp.
That's the exact reason I wanted to simplify the whole thing. Yes.
Right? So let me look at it in the most simplest form possible.
Yes.
All right. Let's say, for instance, you're starting your business and your cash flow requirement is say 100,000. Right. Now, with that 100,000, you're assuming that you could make 20,000 a year sort of return. Right. So in the simplest of form of return analysis, you're looking at a 20% return on investment per year. Now, your investment return is 20%. So now let's look at the cost of funds, right? You would basically shop around to see who gives me the best terms. You go and approach your bank manager. They say, you know what, you take a loan, it's 10%.
Yeah.
Right. So you know that if you borrow, it's hypothetical, the bank gives you 100%, 100,000 fully.
Yeah.
Right. So if you get that 100,000 from the bank, right, you pay the bank 10% and you got another 10% for yourself.
Yeah.
Which is to your equities. It goes to your equity development. Now, businesses can be a bit risky. The cash flow projections and forecasts can be a little bit tricky. Right. Now, if your business is a little bit mature, it's there visible. So with great degree, you might be able to forecast that 20,000. But if there's uncertainty, probably there could be a risk even you might not make 5,000. So if it's a little bit risky, right, then the question is, should you go for a bank loan? Because in the event you cannot make your hurdle of 10,000, you might end up actually selling some of your own assets, equities, or your properties to bridge that 5,000 which you had to pay the bank.
Yeah.
Right. Plus, you still owe the bank the 100,000 which you have borrowed from them. Right. So, in that case, I would ask your audience to think twice. What sort of financing should I go? Should I go for debt or should I go for equity? Right. Now, when you go to a bank, banks basically look at cash flows.
Yes.
All right. They look at what's your historic cash flows, what have you been making, right? So, which means when you're always looking to fund a business from a bank, it should be having a track record, or the industry should be such that the bank can easily visualize your cash and say, you know what, this business is going to make X amount of cash, and they would lend against your cash flows. Right. Assuming your business is a little bit more volatile, you're a startup, or it's a guy who's been in business, but he's setting up a new business. There is no history. He's going after new customers and suppliers, which means it's a bit more risky for the bank. Right. So they might not give you 100,000. They might probably give you part of it.
Yeah.
Then it's up to you whether you're going to bridge the balance from an equity or whether you're going to self-fund it by selling one of your assets. right? Now, that decision, which basically involves debt, equity, in investment terms, we call it the capital structure decisions because it involves around your capital structure. So you get it from debt, you get it from equity, and you then try to manage the return because you know the bank, you have to pay 10%.
So, yeah.
Right? And the event your business gives you 5% on that 100,000, at least you know, okay, if you get 50% from the bank, you can still pay the bank the 5,000. And the equity holders can get the return in the following year because there it's whatever is left goes to the equity. Right. So, in terms of deciding what sort of investor, so I would say that's your primary decisions node. Now, there is another third complication coming into this. Now, if you're doing funding a business idea, all right, because when it comes to a business idea, there is no processes, there is no cash generation, it's basically you're funding it based on a concept.
Yes.
Right. Now, that involves another degree of sophistication. So probably who might actually fund it could be an entrepreneur who's seen that investment growth cycle and they say, you know what, I believe in this, I believe in the story, I like it. Or it could be a seed fund which have funded similar sort of companies like you, have that experience track record, and they will end up funding you. Now, they might take a different payment term for that. They might want a chunk of equity for that. Right. So, but there'll be a lot of due diligence which they will do. So those are probably the broad three areas or the decision nodes which you'll be looking at. And with a simplistic example, hopefully, I made it simple to your
Absolutely.
audience.
It made a lot of sense. But I want to ask you now, you put the investor hat, right? And I found a walks in. What do I need to have in my business? What do I have to prove to come to a room with an investor when I'm asking for investment?
Okay. So when you're going to a room with an investor, asking for an investment, because I think the way of looking at it is you always got to look at it from the other side because who you're going to pitch it to,
Okay.
right? Because now if you're going to pitch it to an investment fund, their job is to generate a return out of investing in companies like you. They will be looking at probably hundreds of companies and trying to pick up the 10 to 20 companies which they will put it into the deal pipeline to evaluate.
Yeah.
So when you're pitching it to them, it's always important to understand what sort of investment strategy these companies have, what sort of companies they typically like.
It differs from person.
It differs from investment fund to investment fund.
Okay.
Because there are some investment funds which are willing to go pure greenfield, some which would want to invest in more predictable cash flows, some will be looking at turnaround stories, some will be looking at backing a key man, some will have a mix of all. So it's always important to understand the strategy of the fund or the person you're pitching to. Because when you're making the pitch, you got to pitch the keywords which will get you the second meeting.
Right.
Right. Because if you fail to pitch the keywords,
Yeah.
right, they're not interested to go beyond that.
Yeah.
Right. So in your elevator pitch, you just got to study your investor first, right?
Yeah.
Put in the keywords so that they say, okay, interesting. Maybe let's have a second chat. Yeah. And so it's important to get that second chat.
Leo, if I'm to ask you, now you would have worked with multiple investors and you would have been in different rooms. So when a founder walks in with an idea, what sort of a viewpoint or a mindset that you'll have towards them?
I think when a founder walks in first, right, we look at for non-verbal cues first.
Okay.
See how confident he is with the investment idea itself, because I think if
That's very interesting.
The person asking for funding is not confident in the idea itself, right? You got an issue, right? Then the other thing which we will subtly check is to see whether he's got skin in the game.
Okay.
Uh,
What do you mean by that?
okay.
Elaborate a little.
What I mean by skin in the game is like, say for instance, he's got an idea,
Yeah.
right? He's saying, I got this brilliant of launching this product, doing this, right? But he's still working for somebody else and making a living.
Right. Right.
He has a secondary source of income.
Right. Right.
So he's not fully dependent on the success of this business.
Right.
Or say for instance, he has borrowed somebody else's money, right? Probably his friend's money, put it in there, and now he's coming for more money from you. Right? So technically, this guy, even though he sounds convincing, doesn't have anything fully invested in the business, because the way of looking at it is that if he has no interest in the business, he's not going to have an interest on your capital. So you have to be conscious about that. So he should be confident and he should have skin in the game. So those are like the two immediate filters which we'll be looking at when it comes to an entrepreneur, to an investor when they're coming to for fund.
Fund funding. Yeah.
And most importantly, we'll be looking at his grasp of the moving parts of what's happening around.
Right.
Right. Because you may have the most brilliant idea, but if you don't know how to run a production line, product process, development, work with people, you're looking at a trouble.
Leo, if I'm a founder who don't have much of connections, very small network that I have, but I have a small business with a big dream. For that sort of a founder to find an investor, what would be the steps to take?
Okay. You're a founder, right? Does not have an investment network. Right. End of the day, you could flip around and ask the question, what is a business? It's a network of suppliers. It's a network of customers.
Yes.
Right. If you cannot build your supply and customer network,
What are you doing here?
what are you doing here?
Yeah.
Right. So if you have the capability of building your supplier and customer network, finding the investor or tapping up to the investor network,
Yeah.
is no issue, because if you're doing something really well, right, somebody will always identify you.
Yes.
Because looking at it from the point of view of an asset manager, especially when you're managing a fund,
Yeah.
right, you have lots of pressure when you're managing a fund where you're supposed to deploy capital into an economy. You have lots of pressure to find the most budding, the most greatest business idea entrepreneur to invest in. So that's your pressure as an investor.
Yes.
So same as what you want to plug yourself in and find the investor also wants to come and identify you. So the important thing is you have to network, and your network is your net worth.
Good. Very good. Let's say I want to pick an investor which is suitable for my business, because there are different types of investors, you were telling me. Right? There are different types of investors. They have a different risk appetite. They have a different viewpoint into business and so on. So if I'm to pick a right investor for me, what is like the process? What do I need to really consider?
It's about alignment here,
Mhm.
right? Now, what I mean by alignment, so let me just take a little bit of describing this a little bit more, right? Now, one might ask, what's the difference between a businessman and entrepreneur,
Yes.
right? Because this term sometimes gets loosely used between a lot of people. Say he's an entrepreneur, he's a businessman, but when you're looking at these two, and businessman basically looks at an enterprise where the cash flows are known, the types of customers are known, the product is known, the service is known, And what the businessman is more focused on is actually doing something better than the competition and making a return.
Yeah.
Right. An entrepreneur, on the other side, aims at a target which is today not visible
Solve a problem.
to solve a problem. So their mindset is more about problem solving. Right. So when you're speaking with an entrepreneur, the first question you have to ask is, what's the problem you're sorting? Right? When you're speaking to a businessman, you're more focused about your returns, products, supplies. Right. Now, when you're looking at these two, businessman and entrepreneur, it falls into two different classes. When you're looking at a businessman, it's more transactional focus.
Yes.
When you're looking at an entrepreneur, it's more value focus.
Yes.
Right. Then, when you're looking at the funding side of it, right, when you're identifying an investor to fund your business, you got to see whether your investor is more focused on funding a transactional business or a value business. If you're a value business and if you go and get funded from a transactional investor, it's like you're getting to bed with the devil. That it can turn in very, very bad situation.
Is this where that you see, Leo, where that the founders who are starting off with so much passion lose the passion, and you get really stressed out, and where that the whole service, the caring, the passion, the love, and everything goes off the window.
Yeah.
Right, and you go right behind the numbers low.
Yeah. Spot on, Hashan, because if you're going after a transactional investor, right, he's not bothered about waiting for the product to mature to generate a return. He's more bothered about the targets, right? He's going to set, and whereas an entrepreneur has a passion, they want to create a change. They want to create a solution to a problem.
Yeah.
Right. A transactional investor will be like, you know what, this is making money. Okay, let's milk it more.
Yeah.
So they are not bothered about too much about the impact. They just want the return. For an entrepreneur, this can be a major issue because he has a vision, a dream of doing something. Suddenly it's cut short and he's asked to go in another direction, which technically doesn't support what he wants to do, but he has to do it. If not, the funding is cut. So, and that's where actually in most companies, which when they get onto the growth cycle, the entrepreneur gets kicked out of the business.
Right.
Because he's not in alignment with everybody else. And after sometimes the business does well, sometimes it just goes down because they have lost their main purpose of why they're in business.
The mojo is gone.
Yeah, mojo is gone.
So, see, when I'm to, what is this difference between you were talking in these lines, but I want it more elaborated, where that a good investor versus a nightmare, right? What are like the red flags there when you go to discuss for funding with an investor? What are like the red flags that you can see?
Okay. As I said earlier, when you're an investor, you have a particular investment strategy.
Yep.
Right. And you just got to do a due diligence on the investor itself. It's called the investor due diligence, right? Because end of the day, you're selling your idea to them and you're expecting them to be in partnership with you on the long journey. So you got to do a due diligence on the investor.
On the investor.
Right? You got to look at, see what his experience or what his track record has been, right? Whether he's just setting up a fund and looking to make you his first investment. So then that's an immediate red flag. Never had a success story as an exit investment. He has invested in about 3 or 4 companies, but never had a exit. So then you got to ask, right, what's the issue? There could be an investor also with excess pool of capital, right? But they don't have the investment track record or the expertise to generate a return out of it, because when you're a sophisticated investor, what you give to the entrepreneur is also free advice.
Yes.
You may have the money, but if you don't have that depth of experience, you cannot impart that experience to the entrepreneur to turn around, because That's a other significant benefit of an entrepreneur going to a sophisticated investor and getting capital is that free business advice. Because it's in the investor's interest also this entrepreneur does well. Because he might invest with you X, the return might be 3, 4, 5, 6X, which is much more than what he would get from a bank. So he's also should be aligned with your success. So if an investor is not aligned with your success, then that's an immediate red flag. I've heard this many a times in Sri Lanka. Quite a lot of sophisticated investors say this. You know what? We are too busy. You only got 10 minutes to make this pitch. If not, that's it. Well, if an investor is too busy to hear your pitch, he's going to be too busy to basically make sure you do well as an investment. Then another thing which I hear quite a lot of investors making this investors make a comment is, you know what, we invest in 10 companies, one goes, it gives a return for the losses of the 9 companies. Now, that shouldn't be the case, because which means they're playing a probability game and not actually a sophisticated in where you're actually trying to harness the return of the investment. You're not doing a proper due diligence. You're just dumping in money into a problem and hoping things will come. So that's also another red flag. So when you're speaking with the investors, when you're speaking, see what they say. So they're all red flags. So then you don't know what this is not my guy.
Yeah. Sometimes out of frustration and desperation, you go and really stick into an investor who's willing to put the money, isn't it, Leo?
Sometimes you do.
Yeah.
And an entrepreneur who is really, really passionate might do it. But also, it leads to a situation where the entrepreneur, he might be shrewd, because then the entrepreneur also is not honest, because he also knows, you know what, I only need this guy's money,
Yes.
right? And I'm not going to give him control.
Yes.
And he will still have to dance to my tune, because as long as you don't have control, you'll be dancing to the entrepreneur's tune.
Yeah.
Right? So from the investor's point of view also, that's also another part of their due diligence when they do on the entrepreneur. They'll be checking to see, you know what's the motive.
Leo, if I'm going for a pitch, right, in my pitch deck or in my pitch, what are the most important key ingredients? Now, you said before, when a founder walks in, you first look for non-verbal cues, right? Okay, fine. That is very important, right? But okay, as a founder, I'm taking my pitch ready. I'm ready, preparing my pitch. What are the key ingredients need to be there in my pitch when I go to pitch to an investor?
Okay.
I'm talking from a point of view of a startup.
Yeah.
At the early stage where they're raising.
Okay. Now, when you're looking at it from the startup's point of view, right, you're looking at an idea itself, right? And you need to justify how your idea, because you're starting off with a problem statement.
Yes.
Right. This is the problem, and this is the problem I'm trying to fix. Right. So your problem statement immediately should align with the investor. So the investor also should immediately identify that, you know what, this is the actual problem. Now you have aligned the potential investor with your problem. So then you need to come up with what's going to be your solution for that. Right. So then you need to be pitching a solution.
Yeah.
Right. Now your solution would have your addressable market, your product or service you're going after, how you're going to make it different to what everybody else is doing. These are the people, this is the process, this is the technology. So you'll have that whole stuff which you would be pitching to the investor. Now, the investor also should be able to immediately grasp, okay, fine, this makes sense, the product makes sense, the process makes sense, the entrepreneur has experience in doing something similar, he seems to be energetic. So they're also ticking certain boxes as they're having the chat with you, right? So when you're doing your pitch, you have to make sure you also give them the meat to help them tick the boxes.
Tick the boxes, yes.
So that's why you go on the normal pitch. So and that's the important thing. You follow that process. So my advice to a startup entrepreneur is always see Google it and see what are the characteristics or what should be in a great pitch, and how business idea fits into that, and make sure you stick to that pitches, the each point, and you pitch accordingly. And also don't make it too theoretical, right? Because if you cannot, in the most simplest term, describe what you're trying to do, the people who are trying to deal with you, people who are trying to, will never understand what you're trying to do.
So, Leo, what are the common pitfalls that you see where these founders go through when they come to pitch? Because I'm sure that you would have sat through these founders coming into and pitching ideas. But what are like the common pitfalls that, common errors that they have in their pitch?
In my sphere, which I originally was involved in pitching,
Yeah.
following pitches, I was dealing with a bit more mature companies, and some of them actually used to come looking for cash, but they don't come up with a concrete strategy. So there is no alignment with the strategy, how they're going to make money. So that's lacking. Now, that's the broad definition. Now, the moment we figured the strategy of what this person is trying to do, right, we would look at the detailed action plans on how he's trying to get there.
Yeah.
Right. And most founders, most people doing the pitching, and it's the same for startups, don't have the clear action plans of getting them from point A to point B. It's like you're going on a journey. You're saying, you know what, when I'm going on this journey, and this exciting journey, probably we'll take the train and go from here, then we'll take the bus and go from there. We'll cycle across this thing, we'll take a boat across this river.
Yeah.
So you're creating a journey, right? And then somebody who knows that terrain, no, it makes sense. This is what, right? And then you convince that person to join you on the journey.
Yeah.
Now he has his tick list. Okay, now is the time to take the train.
Yeah.
Now is the time to take the bus. Where's the boat? The boat is there. Right.
Yeah.
Right. So that's what your investor also would do when he's invested with you, because when you're on the journey, they'll be constantly reviewing. And the investment discussions also would be like, well, you promised that you would do this particular action item on this date of this. What's the status of it? So that's a conversation that your investor would have with you.
Yeah.
So if you don't set those stages, it makes it difficult for the investor to quickly evaluate your one. So that's going to be a delay. So I would say lay that out very clearly, because it's like human, because you're again going back to the human behavior.
Yeah.
You find two pictures, you will always favor to the one nicely presented versus something which is maybe a great idea, but it's badly presented. Yeah, that you will not look at it. Maybe you will just go. So it's always in your interest to make sure it's properly presented.
How can a founder avoid being lowballed? How can they decide what to give and what not to give in a conversation?
That's quite a difficult one to say, because there are many moving parts onto this.
Yes. Okay.
Right, because idea without capital is only an idea. Right. If the founder has set up something, and then if the capital comes, it gets going. If the founder has already done some work on it, right? So then the capital is only pushing it. So the way of looking at it, I would say, you know what, the way of for a founder to ensure he doesn't get lowballed, right? He's always better incentivized to have conversations with about 2 or 3 investors.
Okay. Rather than you straight away
Just
going
one person, because now it's like demand and supply, right? Because I'm going to invest in you. I know you have a great story, you have a great company, right? And I'm mentally thinking, you know what, I'm going to invest, say, 10,000 for a 20% stake in you.
Yeah.
Now, in return, you're going to have a conversation with 2-3 people and say, well, they want to invest with me. What about you guys? Haven't you looked at investing in me? So then somebody else pitches, you know what, I'll invest 10,000 in you for 18% stake. Somebody else is at 10,000 in you for a 15% stake. So now you got 3 sets of investors giving you 10,000 at different stakes.
Yeah.
Right. And that's the power of entertaining many discussions. Now I get to know that, you know what, there is 2 competing investors, and I know this is a great idea. I know I can do it at 15%. So Sandy got a deal. Again, boils down to trading because for an entrepreneur, they should be savvy enough to pick it, play their investors versus just getting rolled over, because if they cannot play their investors, they cannot look after the investors' interest because they'll be rolled over by their customers.
So, Leo, these questions that I'm asking may be a little on the very ground level, but there are a lot of the startup entrepreneurs out there who's really confused as to what to do right now. So it's very important that we have this conversation and drive this knowledge and transfer this knowledge to them, because this is where that they really get the understanding of how to go. So my next question to you is like, where when it comes to deciding on how much am I to raise, right? Of course, we look at the operation and the costs involved and so on, so forth. But where do you think where these founders take it, miss it, right? When they are really trying to figure out how much to raise, is there any points where that they have missed to calculate that they get blindsided in their own operation?
When it comes to founders, by nature, founders tend to be quite optimistic, right? And optimistic to the fact that you tend to under budget some of your actual expenses,
Okay.
right? Or you under factor certain moving parts, because in a business there can be many moving parts, right? Because when you're a founder, the most comforting fact is you have a long enough runway, right, to make sure you can deliver the value you want to deliver as a founder. If your runway is too short, right, then you'll have to really struggle. You have to reduce all the weight. You have to make sure the wind is perfect for you to take off, because you don't have the breathing space. So I would say for an entrepreneur to decide how much they want to raise, they need to say, okay, this is the shortest runway I can actually take off with.
Yes.
This is the comfort runway I can take off with. And they should be looking at something in between. Because if they get it too short, they're better off being on the ground than wasting time.
When we are getting into an agreement with the investors, right, what do I need to be very mindful of, like, certain clauses and so on, where that we, as the founders, we might miss it, right? Where do you think that we need to really focus on?
End of the day, right, for an investor, when he's investing in a founder, he will want to make sure that the founder's interests are aligned with the business or what he's trying to do. But there can be certain clauses in the contract, right, which can prevent you from doing certain things beyond that, because a business itself is risky. And if there is any particular clause, because end of the day, a founder might be aligned to a specific skill set or a specific capability, right? And if the clauses prevent them in the event of a failure, even from going beyond that, what it does is it goes beyond investment protection and it disrupts the founder's rice bowl. So the founder, whenever he's looking at a clause, he should look at clauses which, if things doesn't work, things don't work most of the time, right? But it still gives him the opportunity to survive.
Yes.
Right.
Yes.
So he shouldn't sign off any clause which would actually kill him in the long term. This one, nothing. So there can be certain clauses which can be totally unfavorable for the founder.
Have you come across anything like that in your?
So basically, not pure non-compete, but it's basically non-setting up a similar sort of business for a foreseeable period. So which means, you go out of business, you don't have income.
Right.
So you become a technical dependent.
Right. Tell me, Leo, what are things that investors secretly admire about founders, but they don't really speak out or show out there?
I think
I'm sure these questions you have not thought through as well, but
Yeah.
I'm just putting it to you.
no. I think no. No, it's like this, right? You go to a market.
Mhm.
There are two vendors there trying to take you on a journey.
Okay.
You would most likely go with the guy who demonstrate a certain sense of confidence. He knows what he's talking about. And because this guy is passionate about it, this guy knows about it, and he knows whatever difficulty you come across.
That assurance.
Assurance is there because in a business you're going to come across lots of difficulties. Then from that's that pure gut
Yes.
feel sort of investment you're looking at. But beyond that, you'll be looking at their character, their integrity, honesty. Have there been any issues where he has not paid somebody, not done something right? So basically, you're looking at those sort of subtle things. Probably we might even do a thing like, go out with a founder for a coffee or go out with and see whether he actually pulls out his wallet to actually pay.
Yeah.
Because if this guy is too thrifty, he's going to figure out ways to take the money out of the business.
Right. That's a good one.
So there are like loads of like subtle things which you just evaluate, because when you're actually going out and meeting people, you're not only just going and having, but you're looking for those little non-verbal cues.
Yes.
So business is all about that. End of the day.
If they can't be with that, with the big money also.
Yeah,
it's
they
there.
can't.
Yeah. So, what is that one thing that you wish a founder knew when they come for the money before they come for it? What do you think that they wish? You wish that they knew?
The one most important thing which I personally believe if the founder knew was the investment strategy of actually the person they are meeting.
Mm-hmm.
Because let's face it, that will save both parties a lot of time, right? Because say for instance, if the founder is looking for a value sort of investment and I'm a transactional based person,
Yes.
right? Before the conversation starts, I know it's not going to work. Founder is wasting critical time and resources preparing for a pitch to come and pitch for me.
Yeah.
And I'm spending a lot of time, which I could be looking at another investment. So there is immediately no match, but you still go on with the meeting. So I would say that's the critical most thing, because you know what? It's no go even before the meeting.
Yeah.
But you're just going through the motions, spending a day, spending time, resources, everything, and at the end of probably a week or 2 week of email exchanges and all, you get the call saying, sorry, we have evaluated and not. For a founder with the idea looking for capital, that time is very critical.
Yeah.
Right? That costs a lot of money.
Now I'm moving into this business finances because I'm sure that you've worked with multiple companies in different scales as well, Leo. So it's all about you financially being secure because finances are the it's one of the key elements of the business, right? You need to have your finances, otherwise you're drowning, right? So what are like the key principles that you would suggest for a business if you're starting off, how to make it secure and grow? What are like the steps? What are the principles that you'd follow?
I think there's a particular point which doesn't get a lot of emphasis on a business. But for me, the most critical thing of any business is your cash flow. You should have absolute visibility of a cash flow. And even though you're a business or a startup or anything, you should have from day one the diligence and the commitment to invoice, collect, and make your commitments. Right? And I think cash flow is the most important thing, because at the end of the day, that's what gets most businesses strapped.
Yeah.
Because they don't have lots of visibility on their cash flow. Because I come across many companies when the day-to-day this thing. Here in my business, I'm willing to pay companies, but they are not bothered about actually collecting cash from us. Right? Because they are internally not wired for cash collection. Right? These might be big companies. I don't want to quote names, but this is the story. And month end, you might have these very same companies preparing debtors collection lists. These are the payment. These are the people who owe us. But you know what? They are not following the due process of actually actively collecting. Right? because the people are just not wired to collections.
Collection.
So I think if businesses focuses on cash collection, actually the funding costs might come down. But it's all opportunity cost of capital, because the more money you get into your bank, your overdraft facilities will go down, right? So your working capital cycles will improve, right? There have been instances where we have bought companies and just turned it around purely on the working capital.
Really?
Yeah, you make money on that, because that's an area which a lot of people don't put great emphasis on.
See, Leo, now you can have a brilliant idea, right? But you might be financially collapsing, so the whole business collapses as well. What are like the mistakes? Like, okay, cash flow can be one element that you have for that, right? But what are like the other factors or mistakes where the founders really make where the business collapse because of the financial indiscipline?
In any business, you should have the positive vibes.
Mm-hmm.
If you end up paying your suppliers late, if you end up unnecessarily squeezing them for margins, because even your suppliers are doing a business, you squeeze them for a margin, they're going to sell you their second grade stocks.
Yeah.
When that stock or that goes into the production process, your end customer is going to feel the difference.
Yes.
It's something like you go to a great coffee shop, you enjoy the coffee and you enjoy it, but
Yes.
after some time you find there's a difference in the taste, right?
This happens.
Yeah. So because you know something's wrong with the taste, but actually it's something wrong because these guys have been squeezing the supplier. They've been doing something upstream that, you know what, it actually ends up in the customer's palate.
Mm. After all, it's your own business that you.
It's your own business. So you got to operate with proper ethics, proper values, because end of the day, you just got you're in there to fix a problem as business. Even a business is there to fix a problem. And the difference between a good business and a bad business is a good business finds a way of doing the simple things in a super way.
Mm.
In a great way, they find to do the simple.
Simple things in a super way.
Yeah.
Fantastic.
Right? So that's the difference between two businesses.
Wow. Theo, let's say a small to mid-scale business, right? Can you share with us a financial framework, an ideal framework that they should be operating in the sense like in a certain percentage goes to a security bucket or this and that? Is there something like that you want to share?
I would say on a framework in itself, because it's very difficult to say for a small business.
Understood.
You got moving parts, business to business. It's different.
Or else if you can just at least tell these are the areas that you
Yeah.
need to look into.
But what I would say is, as a rule of thumb, you got to have your eyes on your margins,
Mm-hmm.
right?
Right.
Because if your margins have been squeezed, you know that's your headline thing of you're running into issues, right? If you're having expanded margins, also it's a concern for you, because then you need to see, you know what, would competitors come and squeeze it out? So business is all about being on top of the game every day, right? I would say, you know what, going back again to that early example I said about runway, because what you got to constantly be in a position, even if you're a mature business, right? You got to say, okay, if the world stops tomorrow, if my product sales stop tomorrow, how long can my business survive? Meeting all the mandatory commitments. Your mandatory commitments, it could be your business premises, your employees, your whatever. Because you might say, you know what, I can survive for half a cycle. Some might say, you know what, if everything stops with my mandatory commitments, I can survive for a full cycle. All right. Then what that demonstrates to your customers, suppliers, and everybody is financial strength. And that's what you see some of the mature companies marketing. This is our balance sheet, this is our strength. Because you know what, that's what they're telling their customers. If the world stops tomorrow, you still be dealing with us.
Yeah.
Right.
Won't
We won't be belly up tomorrow. Right. Especially if you have a critical product where your customers are highly dependent on, they'll be looking at a financial strength. So it's important to have that visibility of and give confidence. And also, business is about having the right employees on board, right?
Yeah.
The first people to figure that a business is struggling is your employees,
Yes.
right? You don't want them suddenly going and trying to join your competitor, because then the competitor knows you're in trouble,
Yeah.
because they have industry experience. The competitor will be taking your employees, and then they'll be taking your suppliers, they'll be taking your customers, they'll be taking all the relationships. So I think that runway to manage through a cycle if nothing happens is critical, because you're then demonstrating financial stability, financial strength.
See, you were talking about cash flow. This really got into my mind. Uh, what is healthy cash flow is like, in the sense, for you to have a healthy cash flow practice, uh, what is it like? How can you explain this? A healthy point of cash flow.
I think the healthy cash flow, I would say, is you should be able, you should have very low cycles, cash flow cycles, because your net cash requirement is less. Because what you're doing is you're collecting money quickly from your customers, and you're having the right payment terms with your suppliers. So your actual bank funding of that cash flow, or the amount what you require, is less, right? Now, that cash flow, right, just because that cash flow is there, right, it can be a massive opportunity cost if you have too much of cash flow. Because then you got to make a decision what you're going to do with that cash, because having too much of cash also brings your return on equity down, because your cash should generate more returns. So then you need to be looking at what you're going to invest and deploy your capital in. So I don't want to confuse your audience by going into that sort of decision notes.
Okay.
But ideally, I would say, what, the healthy cash flow is where you can meet your daily obligations without any issues, not stressing about stuff. Having that cash cushion for that cycle of operation if nothing happens. That's I would say the ideal cash flow. And then in terms of visibility, I would ask your audience, especially people running businesses, always to have visibility on the runway. You have cash flow enough for 6 months, or cash flow enough to run the business for 12 months. What's your idea? Because for some businesses, it might be 6 months. Because after that, the cycle changes again, they get their cash. For some, it might be 12 months, right? For project businesses, it could be 12 months, because probably they will be getting annualized cash.
Yeah.
So it depends on the business to business. It depends.
As a small business owner, when do you think that they need to see debt is a good thing as well, right? Yeah, if you strategically play, when is it the right time to get into debt?
I would say for a small business owner, the right time to get into debt is when you have absolute visibility on your cash flows. Because if you don't have visibility on your cash flows, if your cash flows are uncertain, don't go for the debt,
Okay.
right? Going back to my earlier example, right, your requirement is 100,000, right? But your guaranteed visibility on cash flow is only 5,000. Then you can, without borrowing, you can take 50,000 of debt. So you need to figure out how you're going to find the balance 50,000. So that can be a decision for you.
Leo, I'm just getting into the country situation, right? Where that, high inflation, uncertainty, things change overnight. And in this sort of a situation, how does this investment and return and whole this cycle works? How would you look at it?
Okay. There are different types of investment products, right? You got the bank deposits, which give you a basic return. And most of the time, your bank deposit is designed in a way to take your long-term interest rates plus a marginal real growth, and that's what determines your return. Now, in terms of volatility, when there's a high inflation, you need to be looking at stuff which will protect you with inflation or protected stuff, right? Now, what I mean by inflation or protected stuff, you could even look at things like land protects you a little bit from for inflation, it doesn't adjust immediately. It adjusts over a period, because the argument is, say, for instance, somebody earning 100,000 would buy your land at 1 million. Suddenly, there's high inflation, right? The guy earning 100,000, suddenly his disposable income gets squeezed. So he has to wait for a cycle for his 100,000 to go to 200,000 to adjust for the new inflation. And then probably in 5 years down the line, he'll buy your land for 2 million probably.
Yeah.
You having that land over that 5-year horizon, you have protected your million into 2 million. So you have inflationary protected it, right? Similar, you could look at even gold. To an extent, it protects you from inflation. Also, it's a safe haven. If there's uncertainty, a lot of people go and put money in gold, right? But it's not a good investment. Land and bare land and gold, I must warn you that they're not good investment, because they don't give you a return. They're passive assets.
Yeah.
Right? They are it's more speculative in nature. Right? Because you're buying it with the hope of it increasing.
It will increase. Yes.
It doesn't give you a cash return on your investment. So then, if you're looking at cash return on your investment, you should look at a little bit more investments which gives you that inflationary cash flow into it. So probably one of the good investments is look at probably companies which give you inflationary adjusted earnings into the market. So you could actually look at the stock market, because corporate earnings get inflationary adjusted. A company that's making 100,000 next year will make 200,000, because they have managed to pass on inflation into their customers, which then gets reflected in their earnings, which gets adjusted in their share price. Right. So that's another way of protecting yourself. But make sure what you're investing in is a company that can pass on inflation to their customers and put it into their earnings. If not, you're same as having the money in the bank.
Right. So I'm coming into becoming an investor from the investor's point of view. If I'm to become an investor, what is the first step? Like, what are the initial steps that I need to take?
All of us are investors, as I said, starting from the beginning. Where all of us, because as long as we got a pool of capital, we are the investors.
Yes.
Right. So I think we have already taken the first step, and we have already put money in the bank.
Yes. Yes.
So, right. I think the step we need to now move on is increase our level of sophistication as an investor, because we could be a passive investor, or we could be a little bit more active. Because end of the day, keeping money in the bank would generate a certain amount of return. But if you want a higher return, a risk-adjusted return, mind you, the more you become sophisticated, you're taking more risk also.
Yeah.
Your sophistication is a part of your ability to tolerate that risk, to absorb, to put in a process behind that.
Yeah.
Right? Now, one way you could do is, if you don't understand the market, you could always go and invest in a money market fund, or a fund that gives you exposure into the stock market. It's a passive way of getting market returns. Now, over a short period, you might have, like, 1 year you might get 20%, 30%. Some 1 year you might actually lose money.
Yeah.
Because that fund fluctuates. But the idea is that over a long period of time, this fund should give you a risk-adjusted higher return above what you would get in a bank.
Yeah.
And if you look at the track record of some of these funds, they have, over the last few years, they have actually delivered. So you just got to look at, do your own due diligence, go through the data, study it, and try to figure that out yourself. But I would say don't put all your eggs in one basket.
Right.
Just take a small amount. I'll put it in this manager. I'll put it in this fund. Because at the end of the day, if one guy fails, you don't lose all your money. These collectively perform, you're better off than doing nothing.
Yeah. Let's say I have to make my first investment and nothing seems safe and it's very risky. In this sort of situation, where do I go? Of course, you were talking about this, but I want to go into more deeper specifics.
I think, let me say it by this way. Okay. Whatever seems safe might be the most riskiest thing. You might put all your money in a bank and the bank collapses. We've
Yeah.
had situations where you had depositors actually going and fighting in the banks, right?
Absolutely.
So I think it goes down to that same argument of don't put all your eggs in one basket.
Hmm.
And also don't be afraid to try new stuff when it comes to money, right? Because it's always good to have a basic interest.
Hmm.
You don't need to put a massive amount, just put a small amount, right? And see how it fluctuates. Because because you can be of the view of, you know what, I like the market, I want this thing, but maybe I'll study it next year. The story will be different. You like the market, you want it, I don't understand, but maybe, you know what, I'll just put a small amount, less than 1% of my wealth this year, and I think I might get it right, I might get it wrong, but you know what? But the moment you have that, you're tracking it.
Yes.
Oh, this did that, this did this. Oh, why did you do this? You're asking yourself questions. Because of this earnings. And without your knowledge, you're suddenly getting a certain level of sophistication, which you can then question probably whoever is advising you for more insights,
Yes.
and you become a bit more informed in your decisions. And it becomes fun also, mind you.
Yes.
Because when you go and meet people, you're having a conversation.
Conversation.
You know, this year I did this. I don't know how it happened. It's a nice conversation. But what's important is that even a housewife or somebody at home or somebody, I don't understand investments. I don't want to. They might be in that sort of mentality.
Yeah.
But they are trying a pastry business of trying to do pastries, do something and sell and keep their production line, get somebody. Aren't they doing a business?
Yeah,
Aren't they running a process?
yeah.
But they don't want to think of the bigger picture of trying to understand it. And because the moment they understand on the other side, these are how the big companies, so they become more efficient in doing it.
Yeah.
That's how we learn.
Leo, so if I want to go and invest in a new business as a new investor, I want to go and invest in a company that is already existing. What are things that I need to consider?
A company that's existing, because I would say,
I would say a small to medium scale,
listed or non-listed.
non-listed.
Okay. When it comes to non-listed, if you don't have the sophistication, if you're not done anything, you got to see, you know what, whether he's one of your friends, family, or somebody you trust.
Yeah.
If you go and put it to a stranger, because you will not have the investment protections in place.
Right.
That person will disappear
Right.
with the money. You will not have the technical skills to coach the guy to achieve. So you're speculating on it.
Yeah.
So you better put some money, or you're happy to lose. You can be in that bucket of, you know what, I put 10, one kicks off, I make the money. You can be in that bucket probably. Right? But if you're a little bit more serious investor looking at getting that return from the investment, the pleasure of creating a change, doing something productive, making somebody grow, and in return getting, say, you need to have that skill set.
Yeah.
I would say start by probably put a small amount, but don't put too much. But start by actively studying the process behind that, and making an effort to learn that. If not, I would say try to invest in a fund that actually does that for a living. You might be better off and safe, and pick a very good manager who does that.
Okay. Leo, I'm coming to you with my final question. I have $5 million, and I'm coming to you and telling, hey, Leo, I have 5 million rupees here. I want to create wealth out of this. What are like the steps that you would take?
You come with 5 million, right? And you expect me to create wealth out of it.
Yeah.
That you are giving me a broad basket, of a broad definition, create wealth. My first concern is going to be, what's your aspiration for this 5 million?
Okay.
Right? Is this 5 million from your petty cash still? Or is it from your grand savings where you're planning to retire in 20 years and this is going to make 80% of your survival income?
Okay.
Right? I need to ask those questions from you.
Yeah.
Right? Because the moment I know those two, then it's for me, right, to deploy a certain risk profile. on that investment. If it's going to be a grand savings thing, then I know, you know what, I had to be more weighted towards fixed income. I cannot do anything more. I need to spread it down on that. If it's your petty cash, you're looking at something plus minus. If it is in the line, I can play around with it a little bit more, take a bit more risk, and also appraise you that I'm risking it. These are the investments I'm looking at. I'm looking at 5 companies to deploy it, and these are the industries. These are the stage of their cycle. This is the growth story of each of these companies, and these where I think the exits is going to be each of these 5. Right? And this is my return for company A, company B, company C, company D, any. So basically, I'm giving you a statement with what exactly I'm doing. So you know that there is a method to my process, and your 5 million is not just going into a void which suddenly you expect wealth out of it to appear out of a certain period. So I think that's critical, and I think most institutions would be doing that, and I hope they do it, because that's the basic requirement that's needed.
Thank you very much, Leo. So before we close, any final thoughts that you want to leave?
I think the final key thought, and this is something which has always probably worried me the most. Sri Lanka is a country where everybody who comes in for the first time into the country, they love it, and they're so excited with the infrastructure. They are so excited with everything around what they see. Roads are clean, cities to see. We're in the key locations of all the trade hubs. There's lots of optimism for us. But when it comes to actual investment, when you roll up your sleeves and get ready to work and find investment opportunities, there's not much around. Then on the flip side, you have lots of budding entrepreneurs, startup with great dreams, right? Struggling for that capital, not knowing what to do, because the advice they seek is not there. The people they approach, they're not aligned. Then when you end up going for some of these forums which you have market talking about the stock market, how listings and getting more companies to list, we don't have the depth of listings here, right? Because in terms of, I have not done the recent number, but some years ago when I was active and I did all these numbers, what was glaring was listed capital as a percentage of GDP, right? We were about 20%. In countries like Bangladesh and all had about 60%. So which demonstrate the level of underinvestment there is in this country, right? Now, if we are underinvested as a country, we are not thinking return as a country. And it wonders, you know what, why we got bankrupt. It's no concern, because we're not thinking return. We're only thinking about what are the benefits we can get. I think that goes to the basic DNA and the structure, because everybody is talking about the benefits they can get. You have loads of people protesting, I have not got this benefit, I have not got that benefit, but nobody's talking about what's the return to the country. You got students living off the door, taxpayers' money, and asking for more benefits, but we don't have a method of recovering that. Right? So there is a lot of dead investments going, right? But I think it's time that we as a country take capital very serious, right? And we got to make everybody accountable, because the moment you create this accountable process of getting a return, it's only then we become disciplined. Because the moment we're return focused, right, then we become value driven. Right? Because we want to extract returns out of that. A classic example is, which everybody says, you know what, state assets. There's a constant argument about state assets. This guys are selling state assets, these people are selling state assets. But an asset is an asset as long as it generates a return. But we know all our state assets don't generate return. So why call it an asset? So that's my takeaway point, right? I think we should be asset driven, return driven on assets.
Yeah.
And I think each of us should focus on what we can do for the country and how best we can create a better environment for the people living around us. Because if each of us do our little part, before you know it, we will be creating a better environment. So I think that's my key message.
Thank you very much, Leo. Thank you for taking your time to come here and share with us this knowledge. Because even though that you have really scaled it down to a very grassroots level of explaining this, and but it's very important because I believe there are people who are really looking into coming into investment and looking for investors to coming in. These insights would have really, add some flavor into it. And well, of course, we will have more conversations going on in the future about in more detail of this and so on and so forth. Because as PWOM, positive word of mouth, we focus on how we can positively impact. So, if giving this transferring this knowledge through this platform is the main objective, where that they get told of understanding and how they can connect and so on and so forth. So once again, thank you very much for joining with us.
Thank you, Hashan, for having me. And it was a pleasure sharing my experience with your audience. And I hope that you have captured something interesting and you would use it positively in your lives. Thanks, Hashan.
Thank you very much.
Thanks.